even just a 0.25% difference in interest rate makes thousands of dollars of difference in the long run. Welcome again to the Impact School of Money. Today our lesson on the board is going to be about mortgages. So we've covered different terms of mortgages in other lessons, but today what we're going to talk about specifically is the different type of mortgage programs and the approach and what they're for and why they're fitting and maybe the right place, but maybe to just get some definitions and understand a little bit better mortgages and how they work and why they work and why people would maybe look at a specific type. And so you'll hear different terms, and it's funny that one that is quite popular, especially for people that are getting into their first home, is an FHA loan. Well, it's funny, forever I thought that FHA, because it's a lot of times people that are buying their first home get it, I thought it stood for something to do with first time home buyer something, right? Which it doesn't. Then you have conventional loans. Those are going to be kind of the two most common. You have VA loans, and then you have a home equity loan, and then you have a home equity line of credit, or if you've ever heard it referred to as a HELOC. And then the last type that we'll talk about is, well, I guess it's not really more, lots of H's. We have a home equity conversion mortgage, or a lot of people call them a HECM. So let's talk about each one a little bit. So FHA does not stand for first-time home buyers. It doesn't stand for that. It stands for the Federal Housing Administration. Okay, the Federal Housing Administration. And so this is a program that is meant to incentivize home ownership that has, obviously government involvement, as you could imagine. But an FHA loan is separated into several different pieces, and we'll go through how these work in each one. Is that you have the loan that you're getting for the home, so you have the actual loan itself, and then you have a down payment, and that's kind of a typical thing is when you're approaching purchasing a home, or someone is they've got to come up with a certain amount of money down, and then the rest they're able to borrow. And so how the industry looks at it is, and you can get into all the details and the big deep reasons of why, is most lenders, because of the risk of default and different numbers, is they don't really like to take on more than 80% of the risk of lending somebody that much money. And so that's why it's kind of a misconception in the mortgage world that in order to purchase a home, a lot of younger couples, as they're preparing to purchase a home, some of them think that they need a 20% down payment to purchase a home. And so when you're potentially working with a younger client, or you have somebody that you know that's younger, or getting into their first home, a lot of time they think they need 20%, but where that comes from is because no one lender wants to take on the risk of more than 80%, just numbers they figured out of why they want to do that. And so, but then in an FHA loan, the down payment required is, as we've talked about in other lessons, is 3.5%. And so if one lender is, only doesn't want to take on that much risk, well, let the government do it, right? I'm just kidding. But what happens is if there isn't at least 20% equity in the home, then what fills that gap, what fills most gaps in any financial instrument or tool, is insurance. And so there's a type of insurance called PMI, a lot of people call it, which is private mortgage insurance, where basically an insurance policy comes in and fills that gap in that risk until there's at least 20% equity in the home. And so FHA loans have at least a 3.5% down payment. So back in the day, when I had a mortgage license, back in 2006, started in the mortgage industry, there were a lot of people that, and some of you may remember this, is they would go get an 80-20 loan. And so 80% of their mortgage would be from one lender, and then 20% of their mortgage would be from another lender, and they had a first mortgage and a second mortgage. And they could actually, they could even purchase a home that way, or they'd go to refinance. And if you refinance and you're trying to pull equity out to pay off some debt, the highest you could go was 80% from one lender, unless you did an 80-20, and then you could get up to 100% of the value of your home to pay off debt. And so that kind of existed for a long time, and there's different ways that can still be done, but again, is very, very rarely, not saying it can't be done, but very rarely will you find one lender that's going to lend 100% of the value on a home, as we talked about in lesson 22, what loan to value means, and how to access equity in a home, which is lessons we've talked about previously about consolidating or eliminating debt. Okay, so that's an FHA loan. So this mortgage insurance that we have attached to it, as of the time of this recording in 2018, that is a mortgage that as long as I keep the FHA loan, I pay that mortgage insurance indefinitely for the term of the loan. And so even if I get to the future, which is how it used to be, is if I got to 5, 6, 8 years down the road and the value of my home went up, and the balance of my mortgage went down, that I could just call the mortgage company and ask them to remove the PMI if I got to it's 23% equity in my home, 77, 78%. I could just ask them to take it off and they would. Where in today's world, if I have a FHA loan and I get to the after 2013, if I got an FHA loan after 2013, in order to get rid of the mortgage insurance, I would have to refinance my home. And what's crazy is you could refinance it into a new FHA loan, but it's going to be at the rates today. But if I have the 20% equity in my home, then they'll remove the mortgage insurance. Okay, typically, and this isn't always true either, interest rates are fairly comparable, FHA and conventional, but FHA tends to be a little bit lower. Not always the case, but a little bit lower. Okay, the other difference with FHA, not only is the down payment smaller, the mortgage insurance is a little bit more expensive. So this is, down. This is a little bit more than the mortgage insurance you'd get on a conventional loan. But the debt to income ratio numbers are higher. So we talked about it last time on episode or lesson 22, is that the debt that you have compared to the income, your debt can be higher than in a conventional loan. The front end, and this is going to be a test of memory and things we talked about last time, the front end debt to income ratio on a conventional mortgage is lower. And so a lot of time, someone will meet with a mortgage broker. They're trying to qualify. Conventional because the mortgage insurance is lower, or they might be able to arrange like an 80-20, or they might be able to do something to where maybe the payment's potentially lower, but then they go to their debt to income ratio, and the house payment compared to their income, the house payment's going to be a little bit too high, But if they switch over to FHA, because your mortgage payment on the front end can be higher, then they might qualify better FHA, because the loan qualification process, the underwriting is just different for the two. Okay, so conventional, how it usually looks is the lowest you can do conventional with, again, doing the mortgage insurance, is a 5% down payment, and the rest of it is a loan, and then of course the gap is filled with mortgage insurance, or potentially that second, second mortgage. And so then we already talked about all the other features, debt to income differences. So the down payment is potentially a little bit higher, but then the mortgage insurance on a conventional loan is a little bit lower. And then with a conventional loan, as soon as I have the equity in my home, where the value is here and the balance is here, and as this goes up, I create more equity, or as this goes down, I create more equity, or if they both, do this, where my balance is down, value is up, then when I get to that position of 78 to 80%, I can call the mortgage company and they will drop my mortgage insurance without needing to refinance, right? And what's really interesting in how sensitive mortgage interest rates are, because the balance of a mortgage is typically quite large, even just a 0.25% difference in interest rate makes thousands of dollars of difference in the long run. And so you hear of people, trying to lock their loan or lock their interest rate, when rates are down, or they buy down their rate. We could potentially talk about that another time. But just sticking to the basics is, that small interest change makes a big difference in the long run. Okay, VA loan. So, question: who can get an FHA loan? Who can get a conventional loan? Are FHA loans just for first-time home buyers? No. Anybody can get an FHA loan, but you can only have one. So if I'm getting into real estate investing and I buy a home on an FHA loan, and then I live in it for 3, 4, 5 years, and I've got a good rate, and then I move, and I'm going to go buy another home, and I'm going through the qualification process, and it looks like the numbers would work out for an FHA loan. Well, I can't have 2 FHA loans. I can have 1. Okay, but anybody can have an FHA. Okay, conventional, anybody can have, not limited to how many conventional loans you have, but then remembering, with interest rate sensitivity in mind, if I have a primary residence, and those that are listening to this lesson today, some of you I know are in real estate, where you have maybe a conventional loan on your own home, you go to buy an investment property, you get another conventional loan, because that new loan is not a primary residence, the interest rate is going to be higher. Sometimes between 0.5% and 1% higher, just because it's on an investment property. Okay, VA loans are a little bit more specific in who they're for. VA the V in VA stands for veterans. And so somebody that is a veteran, and then I guess I should have looked this up to be sure, or a family member of a veteran is able to get a VA loan. And now that I actually say that out loud, I think that person, the actual person, has to be veteran or Army, Navy, National Guard, something like that. And the qualifications are a little bit different, but there's very select loan officers that can do VA loans, and a lot of VA loans, interest rates are typically lower. It requires no down payment, but then there are different stipulations. And to be honest, in the 6-7 years that I did mortgages, I never ran across somebody that was doing a VA loan. But typically interest rates are lower, debt to income ratios are higher, and it does not require a down payment, but then again, it's specifically for those that participate in the VA. So to kind of round out our lesson for today, let's talk about the H loan. So you have a home equity loan and a home equity line of credit. What's the difference? A home equity loan is, let's say here's my home. It's worth, the value is $300,000. My balance, my mortgage balance is $200,000. How much equity do I have? I have $100,000 of equity, right? But most loans won't go higher than that 80%. So what's 80% of $300,000? $240,000. So they would allow me on a home equity loan to pull out $40,000. So even though that's a home I own, I don't own the equity in my home. I get to borrow it, right? So I borrow the $40,000. I'm going to remodel my kitchen and some bathrooms in my home, and I'm using the equity in my home to do it. But to borrow that money, of course, creates a payment. I have to now make a payment back to that. But a home equity loan is going to be a fixed amount with a fixed interest rate most of the time and a fixed payment where I make that payment back to it until it's completely paid off. The difference between home equity loan and a home equity line of credit is exactly in the description. This one is a line of credit. This one's a loan. So this one I get a fixed amount, fixed payment, pay it back until it's paid off. The line of credit is, it would look the same, but it gives me access to $40,000, but I'm only charged interest on the money that I use. And so if I get a $40,000 home equity loan, they're actually giving me all $40,000, and I start making a payment on it right away. The home equity line of credit, I have access to $40,000, but if I only use $10,000 of it, then I'm only charged interest on $10,000, and my payment's calculated on the $10,000 that I borrowed. And then if I need $2,000 more, I get $2,000 more, and I'm charged interest on that plus the $10,000. And so that can change. And most home equity loans, again, have that fixed payment, the fixed approach. And a home equity line of credit usually has a variable interest rate. A lot of people have maybe heard of the prime rate. So a lot of the time when you're quoted rates on a home equity line of credit, it's prime plus half, or prime plus 1, or prime plus 1.4, or whatever it is. And then I make my payments back based on that. If it's on a primary residence, I can typically borrow a little bit higher. I can get my loan to value to go a little bit higher. I've seen home equity loans or lines of credit that will go all the way up to 90% of the value of your home, as long as they're not doing all 90%. So if you've got a first mortgage that's covering about 70% of the mortgage, they'll allow the total first plus this line of credit or loan to go up to, I've seen a credit union around here in Utah County will go all the way up to 90%. And I've seen some go higher. But that's the difference between a home equity loan and a home equity line of credit. Let's do this. Because this is a little bit more involved than the time we have for today, lesson 24, when we jump to the board, lesson 24 will be on home equity conversion mortgages, why that is a tool in the toolbox when it comes to a financial plan, but it's definitely not the tool for every job. So thank you for joining us on the Impact School of Money today, where our mission is to be the way that people are educated about money, and our lesson on the board was talking about mortgages. So thank you for joining us. Class dismissed for today.